Your dollar may have already lost a noticeable share of its purchasing power over a surprisingly short period of time. Not because you spent it, not because you made a bad decision, but because the currency itself is quietly weakening. At the same time, central banks around the world have been doing something most people ignore. They've been reducing exposure to paper currencies and accelerating their accumulation of gold. Not gradually, aggressively. A new international payment framework has also begun taking shape, one that could allow large parts of the global economy to operate without relying on the dollar at all. This isn't conspiracy theory. These are documented trends that have been unfolding in parallel, and almost nobody is connecting them. I'm going to walk you through what's been happening, why it matters, and how people with real capital tend to position themselves during this phase of the cycle. Several market moves have stood out at the same time. Silver pushed into territory near historical extremes. Gold surged dramatically over a relatively short period, posting gains that are highly unusual by any long-term measure. At the same time, the Federal Reserve has been signaling further rate cuts, even though inflation pressures haven't fully disappeared. Here's the question almost nobody asks. Why would central banks be accumulating gold at one of the fastest paces in decades while continuing expansionary monetary policy? In my analysis, that behavior isn't random. It suggests they're hedging against risks that haven't fully surfaced yet. Let me make this personal. That $10,000 sitting in your savings account. If the dollar's purchasing power quietly declined by roughly 10% over a short span, that money now buys what closer to $9,000 used to buy. Not because you spent it, but because the currency itself weakened. I'm not a financial advisor. This isn't financial advice. This is educational analysis based on publicly available information. But here's what's interesting. The institutions that control monetary policy don't appear worried. Central banks, governments, major financial players. And there's a reason. Many of them have already repositioned their reserves. Industry data shows that central banks have been buying massive amounts of gold year after year. China has been adding consistently. Russia has allocated large sums as well. When the same institutions that issue currency actively reduce reliance on it, that's not noise. That's a signal. The Federal Reserve now appears trapped. If rates stay high, debt servicing becomes a serious problem. Some fiscal analyses show interest payments consuming more resources than core national priorities. Meanwhile, debt continues to expand at a pace that compounds the problem. That trajectory doesn't resolve itself quietly. Something eventually adjusts. The only real question is when. In recent months, another development has quietly taken form. Russia has outlined a new currency framework, not a traditional national currency, not a replacement ruble, something structurally different. Depending on the source, it's referred to as a unit or a similar designation. What makes it relevant isn't the name, it's the design. Available information suggests it's partially backed by physical gold, combined with a basket of partner currencies. Some reports indicate an approximate split between hard backing and fiat components, layered on top of blockchain infrastructure. That technical detail matters. Moving dollars across borders usually takes days. It involves fees, correspondent banks, and payment systems ultimately overseen by the United States. This alternative framework is designed for direct, near-instant settlement without a U.S. intermediary. And here's the part most people underestimate. Under such a system, a large share of the global population could theoretically transact without touching dollars at all. No reserve currency participation required. This can't happen here, is the common response. History says otherwise. Germany believed that in the early 1920s. Argentina believed it around 2000. Venezuela believed it a decade later. The sequence was the same every time. Money creation, rate cuts, currency weakness, more money creation, loss of confidence, central banks losing control. I've spent months examining these patterns. They aren't hidden, they're repetitive. And once they start accelerating, timelines compress quickly. That's why this phase matters. Education comes first. Diversification follows. Awareness is critical. Because when monetary shifts reach a tipping point, history shows the transition rarely happens slowly. The dollar has held reserve status for roughly 8 decades. Every reserve currency before it eventually lost that position. Not because of one event, but because of structural pressure building over time. And none of them saw it clearly while it was happening. Central banks reducing exposure to dollars. Gold replacing reserves. new payment systems forming outside U.S. financial infrastructure. Now comes the obvious question. What do people with real money actually do when they see this forming? Because while most people debate whether this matters, the ultra-wealthy don't panic. They prepare, quietly. By the end of this breakdown, you'll understand their general playbook. But first, you need to understand the structure of currency decline. Because by most indicators, we're no longer at the beginning. We're already in Phase 2. Every major currency breakdown follows the same sequence. Phase 1 is silent. Inflation stays manageable. Media coverage signals stability. Nothing feels urgent. Meanwhile, smart money begins rotating into hard assets. Gold rises steadily but without headlines. Silver follows. The moves look unusual but easy to dismiss. That's Phase 1. Capital seeking safety before the crowd notices. Phase 2 is acceleration. Prices stop moving quietly and start becoming visible to everyone. Central banks cut rates even though inflation hasn't fully cooled. Currencies weaken in real terms. Everyday investors start feeling it. Concern replaces complacency. A currency losing meaningful purchasing power over a short period isn't a normal correction. It's momentum. That's acceleration. Phase 3 comes later. I'll show you the exact signals to watch for shortly. But first, here's what the wealthiest 1% tend to do before that phase arrives. When billionaires prepare for currency instability, they don't sit in cash. According to wealth management frameworks, they allocate deliberately. One common structure is the 40-30-20-10 model, 40% into hard assets, physical gold and silver, not paper claims, not ETFs, metal you can actually hold. Because when currencies fail, paper promises often fail with them. Metal doesn't. They also include real estate in stable jurisdictions. Property holds value because people always need shelter. But the key detail is diversification. They don't concentrate everything in one country. If all your assets sit in a single currency, you're not diversified, you're exposed. If all your exposure is tied to a single economy, you're not diversified. You're making a concentrated bet. That's why the next layer typically shifts into foreign currencies, not dollars. Currencies issued by governments with relatively low debt burdens and stronger balance sheets. Holding multiple currencies matters because when one weakens, others often strengthen in relative terms. The next piece is cash flow assets, investments that produce income regardless of currency moves, productive farmland, essential service businesses, assets that generate real output. During periods of extreme inflation, people with productive assets tend to survive. People holding only cash often don't. The final slice is risk hedges. This is where decentralized assets come in. Bitcoin, gold-backed digital instruments, assets designed as chaos insurance. Not because they're perfect, but because they operate outside traditional financial plumbing. If the system fractures, decentralization can matter. But this is where most people make costly mistakes. First, paper gold, ETFs, certificates, allocated accounts. These are claims on gold, not gold itself. In a real disruption, paper promises don't function at street level. If you can't take possession, ownership becomes theoretical. Second, trying to time the move perfectly. Waiting for pullbacks. Historically, during Phase 2 of currency decline, prices tend to trend one way, higher. What looks expensive often gets much more expensive. Third, keeping everything inside banks. Banks operate on fractional reserves. If even a small share of depositors demand cash at the same time, stress emerges quickly. Bank runs aren't rare, they're common during monetary breakdowns. Which brings us to the phase that closes the window. Phase 3 usually begins with a trigger. A major institution fails. A debt auction breaks. At first, it's dismissed as isolated. Then contagion spreads. Withdrawals are restricted. Bank holidays appear. Currency values can drop sharply in days. History shows this happens fast. And when it does, preparation time is over. What remains are the signals that come just before it begins. There are specific signals that tend to appear right before the window closes. They're not subtle, and they don't last long. The first is an emergency rate cut, not a scheduled decision, an unscheduled move between meetings. That usually signals panic at the highest levels. The second is a sharp collapse in major bank stocks. If systemically important institutions lose a large share of their value in a single session, that's not volatility. That's structural stress. The third signal is discussion of capital controls. Any public talk about limiting withdrawals, restricting foreign currency access, or regulating gold ownership. Historically, those conversations happen just before action is taken. The fourth is a sudden spike in gold. A massive single-day move suggests institutional panic, with central banks and hedge funds rushing for protection at the same time. The fifth is a failed government bond auction. If demand for sovereign debt disappears, confidence breaks quickly. That's when reserve currency status comes into question. Those are the signals I watch closely, and when they start appearing together, time compresses fast. So here's a practical framework. Not all at once. Spread over weeks, not days. Start with liquidity. Hold several months of expenses in physical cash. Accessible. Small denominations. Flexibility matters. Next, hard assets. Begin with physical gold and silver, purchased from reputable sources, stored outside the traditional banking system. Then foreign exposure, multiple currencies, stable jurisdictions. Reduce reliance on any single monetary system. After that, income streams. Something productive. A side business. Freelance work. Rental income. The goal isn't growth, it's resilience. This isn't about getting rich, it's about not getting wiped out. I understand how extreme this sounds. Not long ago, I would have dismissed it too. Then I looked at the data. Central banks accumulating massive amounts of gold. Rate cuts alongside persistent inflation. Rapid currency weakness over short periods. The patterns aren't hidden. The only question is whether you recognize them early enough. There's a checklist linked below. Share your biggest concern in the comments. Because when financial systems freeze, the people who laughed early are often the ones standing in line later.